Welcome to the daily update, where I'll go over the action in the market for Wednesday, May 15th, and then we'll see how things look for Thursday, May 16th. CPI ended up coming in friendly, and boy, the markets really took off. Now we're dealing with 5,300 with the S&P. We have the Dow, the NASDAQ, the S&P, the NASDAQ 100, all setting new all-time highs. That's always a positive thing. Of course, as we've been going up, we are looking extreme positive, not only in the short term, but in the intermediate term. But during really strong up moves, this can last for quite a while. As always, there's some things to be concerned about, but for the most part, things are looking pretty good right now. Before I get started, I do have an announcement that I've been making. Starting on Monday, June 3rd, I will be locking down the daily videos. Now, this is only until the close for that day. So if you watch the daily videos after the market closes, or maybe in the evening your time, you're still going to have free access to those videos. I'm only locking down initial access because to me, the daily videos are the most important. That's what you need to do that day's plan. The weekly videos, the intermarket analysis videos, all the other videos, they're going to be freely available as soon as I post them. It's the daily video that members will have first access to. Or if you want to have access to the daily videos and nothing else, you don't want to be in the membership program that I have, that will be $19 per month. It works out to less than $1 per day. If you are a member, it will be included. You don't have to pay that additional $19. The membership is going to be $97 per month. So you can watch them whenever they're posted for the weekly video and then after the close for that particular day. If you have some feedback that you want to offer, here is an email address where you can send either positive, negative questions. I'm trying to talk with some folks, but I'm still waiting to hear back from some emails because I have some ideas that I'm trying to present to folks, and I'm just waiting for a response. So if you do have a question about that, maybe you feel like it's not fair, please let me know. Okay, let's go back and talk about the things that happened right at the open. We had a gap higher open. CPI came out. The market really liked that. The futures shot up. We opened above R2 at 52.71 right off the bat. And we pretty much never looked back. And then prices continued to climb up to R3 at 53.03. So now we're dealing with 5,300 with the S&P. And we closed pretty much right at the daily high. We were up 1.17%. We're still below average with volume, but it was up from what we saw in Tuesday's session. There are some warning signs, and volume is one of those warning signs that we want to keep an eye on. We've been going up pretty good since the April pullback that we saw, but we've been seeing a decrease in volume. Now, in Wednesday's session, it picked up, but it was still below average overall, and that is a pretty big warning sign. We're positive, but extreme positive in the short and intermediate term. You could also say in the long term, but the other way of looking at that is just showing that it's good momentum. The market liked what came out for CPI as far as inflation. Interest rates went down, stocks went up. We'll see if that can continue. And then we want to keep an eye on all the different geopolitical events. Some comments, CPI did come in friendly, and I'll have some charts to show you there. The Dow, the NASDAQ 100, and the S&P all hit new all-time highs. The mid caps did not, and of course the small caps still have a ways to go to do that. We also have some other indexes and sectors that we look at that are also hitting all-time highs. On a short-term basis, we're getting a pretty long list now. We have the Stochk RSI, the Williams Percent R, the CCI 14 and 20, the stochastics. They've been on there. A new one is the rate of change over the last 10 periods. And then we have the McClellan oscillator, which was on the list and then off the list. Now it's back on the list again. The slope oscillator, that's our touchiest oscillator. It's looking a little extreme. The boom indicator based on 20 periods, and then the RSI based on 9 periods. Intermediate term also have a bit of a growing list here. The CMB composite continues to be extreme positive. The standard deviations chart, we're now up into the +3 channel, so we have to be aware of that. The TTM squeeze, which has already been on here for the second day now. The Sean trend meter is even looking a little bit more extreme. We are showing an extreme positive reading with the Bollinger Bands. The %B is outside of the upper Bollinger Band. And then one that was on for most of 2024 dropped off. Now it's back on. Is the 10-day moving average of the S&P 500 highs minus the lows. In the long term, this has been pretty much this way for all of 2024, the 150 and 200 period simple moving averages. I've changed this scenario just a little bit. The Fed will likely leave rates unchanged. That's still kind of what they're going with, higher for longer, as the decline of inflation has slowed. But the timeline is now looking at September. So with this CPI report, we're going to have to see what kind of follow through are we going to get, if any. And now the market is starting to say, okay, we're going to look out as far as September for a possible rate cut. And a large part of what's really been helping the market go higher is that the Fed has been decreasing quantitative tapering. The dollar was down and interest rates were down. We closed at 4.36%, where we had been at 4.45%. Both of these declining gave support to stocks. We're still inverted with the yield curves. Sentiment is now positive. We ticked up from 54. Now we're up to 60. And our trend, I'm calling this a trending environment now because the ADX is trying to come back above its moving average, but we're not above 20 yet. So depending on how you want to read this, you might still think that we're in a non-trending environment, but we are positive with the green line on top. We're trying to get above the moving average, but we're still below 20. With the up day, and bias is usually, did we have an up day or a down day? That's positive. And then the momentum of the last 2, 3, 4, 5 days taken together, that is also positive. The reports that we had first with the weekly MBA mortgage applications index, it was up 0.5%. Last time it was up 2.6%. CPI, this was the biggie. It came in lower than expected at 0.3%. They expected 0.4%, which is what we saw last time. The core CPI, this is what the market really focuses on too. It came in as expected and down from the 0.4% we saw last time. Retail sales, they were unchanged. They expected them to be up. Now, retail sales, it is a big part of the U.S. economy, but since the market's been more worried about inflation, the fact that this actually ended up coming in unchanged was seen as friendly. They expected it to be up 0.4%, and last time it was up 0.6%. When you take out autos, it did come in as expected, up 0.2% and down from the 0.9% we saw last time. The New York Empire State Manufacturing came in with a reading of minus 15.6. That's greater than the -9 they thought was going to happen, and a little bit higher on the negative side anyway, a little bit lower, I guess I should say, from a minus 14.3. Business inventories came in down 0.1%. They expected them to be unchanged. Last time they were up 0.3%. And really, as I go through this, some of these I'm not really going to show you charts of some of these I will. The NAHB Housing Market Index came in at a reading of 45. They expected 51. Last time it was at 51. Okay, here's some charts. First, getting rid of the mortgage applications, because we look at this every week, where it was up but down from the preceding week. CPI year over year is continuing to decline. Then looking at services, when you take out energy and the core commodities, we're going down with the core commodities. That's the yellow line, where we're just starting to roll over a little bit with the services when you take out energy. Here's our chart showing how we're starting to come down a little bit on a 12-month rate of change basis. We did also decline on a 1-month rate of change basis. Here's the core CPI continuing to go down on the year over year or 12-month basis, where the 1 month is also declining. And the market really liked this. The core retail sales year over year are declining, but they're still above zero. Month over month, they were pretty much at zero and did decline from the previous reading. Here's some blog charts. The annual change in earnings is the best indicator. I've shown this, but I don't really have a way to duplicate or replicate this actual chart. This is based on forward-looking PE ratios on a year-over-year basis. I have a daily chart that I access and a weekly chart, and that's about as far as I can go. I don't even think I have a monthly chart of that. But you can see, as looking out into the future, not using trailing 12 months, but future earnings, when this is really going up, the market goes up. And then it can still go up after that because they're still riding the wave of that upward move in earnings. And this continues to go up over here, which could be positive for stocks going forward from here. And then looking at a daily candlestick chart with the moving averages, I do this same kind of thing right here, but when I see these charts, I like to show them to you just because they look a little different. They have different areas that are marked off in the chart just to show, to give you a little bit different perspective. And then weekly global advanced decline line of 73 countries. The whole globe is looking pretty good right now. Now remember, all of these charts are before CPI came out. And then the cash levels actually are declining. They're getting down to a pretty low level. That could be negative, meaning that money that could be used to go into the stock market has already been deployed, but it's still coming in at a reading of 4%. And then the rise in the relative size of the U.S. equity market has reflected the dominance of the U.S. economy, and it's no big deal there. The dark blue line, this is the capitalization of the U.S. compared to Asia and Europe down below. And then what is the most overweight reading right now as far as stocks? This is continuing to go up for right now. And then what's the most crowded trade? It had been the Magnificent Seven, going long, meaning buy low, sell high. That's dropping off a little bit. Folks were getting into the dollar a little bit more as that was going up, even though it's now in a short-term downtrend. And really, you can just look through these things. We're not seeing an awful lot of participation in Bitcoin. That maybe that mania, it had its first wave that wiped out a lot of the weekends, and now the powerful money is coming back in and really driving it up. And a lot of folks, they may not be able to get into that anymore. Economic surprise. This continues to go down, but it did tick up. This is when we come in weaker than expected with our economic reports, and that the market's liking that. This is where bad news is good news. And then risky versus safe assets, we're seeing folks getting more into the risky assets. They're willing to take on more risk. And then this is just the rotation. You still have most people in cash. That could also include money markets. Staples are still seeing an awful lot of money in them and bonds, and you can just kind of see where folks are at. And this is more on a global basis. And I'll deal more with staples as we go through the video. This is put out by Jason Gepfert, and even though he has a spectacular website, I can't use his charts from the website. But this was posted on Twitter, so it's more public, where he has a risk on, risk off indicator. It's a composite of 21 diverse sentiment and breadth-based measures. It surged higher relative to its recent range. It's been going up. It's actually crossing back above this green dashed line here, prompting a new buy signal for a swing trading system. And that's kind of what we do. We go long when the market's going up, we go short when the market's going down, and we get into sideways strategies when the market's going sideways. So you could classify that more or less as swing trading. But then there's also longer term investments that you just hold on to and then check out with longer term charts. Similar precedents displayed outstanding returns and win rates. So this is, and again, well, I don't know. This came in, it was, okay, so this probably was after, no, well, it's not really showing up here in the S&P, but this is a positive signal. But this is something to be aware of. And this really spidery looking line here, the tweet is kind of the takeaway here. And this is what I've been talking about, and I'm hearing it echoed from him. Stocks have been recovering since the April pullback. Okay, we're going up. But most indexes are still off their highs. Now they're not. And earlier in the year, no, they're not. We've now set new all-time highs. Most sectors too, except for two, the most defensive ones. This is the takeaway. Bears suggest that if staples and utilities lead the charge higher, this rally is not to be trusted. I'm not saying it can't be trusted. It's going up. We just want to be aware of this and be prepared if things do start to switch. But historically, the S&P did just fine going forward. Over the next 6 to 12 months, there were only 2 losses out of 12 signals. So yeah, this is something that we want to keep an eye on, and it's utilities and staples that are defensive, but the market still on a percentage basis can go up from here, but we still want to watch this. Then looking at the 90 plus days of delinquency with the credit card debt, that's starting to go up as folks are experiencing the real life economy, which is very different from the Wall Street economy. And there's other things on here as well, but I just wanted to point out the credit card debt. Here's our intraday chart where right after the report came out, the futures spiked higher. We ended up opening at R2 and we just pretty much kept climbing and closed up here at R3, right about at the high. Here's the intraday chart, and then this is where we see the spike up. This is after the CPI report came out, and we pretty much just screamed up from there. We're still looking good when we compare growth to value on an intraday basis. The growth to value ratio for the S&P is showing an improvement on an intraday basis. But end of day, yeah, it was up a lot more than value for the large caps. It was up more for the mid caps as well as the small caps when you compare them to value. But we're not seeing a real big turn yet. And maybe we're getting into an environment where it's okay for utilities and staples to go up. The stock market can still go up, and maybe the growth stocks are going to lag a little bit. Now, it hasn't been what we've been seeing over the last few years since we bounced off the lows in October of 2022, but maybe we're shifting an environment a little bit. I'm not saying that's what's happening. These are just things we need to stay open to because we're not seeing much of an improvement with growth of value with the small caps. The mid caps, yeah, it went up, but not screaming up. And it even bounced up a little bit more with S&P growth of value, but not breaking out by any means. And we're also coming back up, but still inside the rainbow with this other growth to value measure that we follow. And discretionary, it turned up, but it's not really breaking out all that strong either. In fact, it's not even breaking out. It just kind of turned up with the other areas that we look at. Large cap growth is now back setting all-time highs. The Wilshire setting an all-time high. I didn't mention that one earlier. Our trend, we're starting to turn back above the moving average, but we're still below 20. Now, if you're more aggressive, if you're really aggressive, you do the cross. You went short when the red line crossed, excuse me, let me back up. You went long when the green line crossed above the red line. Then you might go long again once we start to go above the moving average. And then you might go long again if we are able to get back above 20. So there's different ways that you can use this, whether you're more aggressive, whether you're more conservative. If you're quite conservative, you want to see the line going up above 20 and above its moving average and the green line on top. And we're seeing a little bit more of a pronounced move with the short-term ADX, but still just barely below 20. Volume did turn up, but it's still been dropping off for the most part. Sentiment, we're still kind of going sideways under the moving averages with the Ulcer Index. We did get another reading from Investors Intelligence. They're back above 3, so they're kind of getting up into that extreme area, but it still could go quite higher than where it's at right now. And we did see the VIX really fall with the line chart and the bar chart after the last couple of days. It had been going up. And volatility did tick down with the bar chart and the line chart with the VIX of the VIX. We're continuing to decline with the momentum of the VIX since it really was down big time. The equity put call ratio ticked up a little bit, maybe a little bit of hedging going on here as folks are having a little bit of mistrust in setting these all-time highs, and they're seeing the utilities and staples doing really well. So maybe they want to come in and buy some puts to hedge their protection or to hedge their position with protection. But we're still declining with our 5-period chart. We're starting to go back up with volatility risk premium. We came right up to the upper band and ticked down slightly in Wednesday's session. This fear gauge did drop off, and we're still continuing to decline with the other fear gauge. And I have one. This is put out by Goldman Sachs. I found it on Twitter, but I wanted to include it in this section. So this is a panic index, and it's just showing that there's not a lot of fear right now, which could mean that we're overextended. It could also mean that we could stay down here for a while and ride the positive wave. Looking at our advanced decline line, we are finally breaking out just barely above these previous highs based on price, and we're just a little bit above that now based on volume. New highs, new lows. With setting the new high, we're just seeing a whole plethora of new highs being generated. So our 5-period and our 10-period continue to go up. This is showing internally the S&P is looking strong. The advanced decline ratio is positive and going up. The accumulation distribution, this is starting to get a little further away from the moving average, and the moving average is starting to turn up. So that's more positive as well. We're also looking more positive with the Chaikin money flow. In fact, not more positive, both with this chart, the accumulation distribution, and Chaikin money flow, we just are positive right now. The Chaikin oscillator is positive. The cumulative advanced decline lines breaking out and positive, as is the NYSE regular advanced decline line. This other advanced decline line for the NYSE is also breaking out. When we look at common stock based on price, we're breaking out, and now we're breaking out based on volume. When we look at the cumulative price for the S&P 500, breaking out to a new all-time high and just barely above this previous high based on volume. All of our advanced decline lines looking good above their moving averages and looking quite positive. And we are just breaking out above this pivot point. We had already been able to get above that. Now, at least on this chart, we don't have more resistance until we get to this next pivot point. Now, there's other resistance that the market's going to find. I'm just pointing out what is evident on this particular chart. And you can see we did come up with volume on the bottom, but we're still below the moving average. Stochc RSI is extreme positive, as is the Williams percent R, the CCI 14, and the CCI 20. Our stochastics extreme in the short, intermediate, and long term. And here's the rate of change, a new one. We're above this red line this often. Now, when we get up to this reading, it doesn't necessarily mean that we're going to stop. It just means that we might slow down for a while. But it could also mean, like back here in June, this did mark a top. So we just want to be aware of that and respect these signals. The boom indicator based on 20 periods, we're getting pretty far away from that 20-period moving average. We're not quite there with the 50 yet. We're just coming up underneath the extreme reading, and we're looking positive with the 200. The 20-period moving average study for the double and triple exponential moving averages, we are looking quite a bit more positive now. The 20, 50, and 200-period moving averages are going higher. The force index hit the upper Keltner band here, so that's a little extreme positive there. Here's our 20-period moving averages, turning up and getting further away from those moving averages. Here we're into the top end of the +3 channel with the standard deviations chart. So that's a little bit of a concern, just meaning that we've gone up a little far fast. Is it too far, too fast? Well, that's what we're waiting to see play out. Intermediate term, the balance of power is positive. The go, no go is positive. The highest high value is positive. The TTM squeeze is going above this black line that I put on here, but we are starting to get a bit extreme positive. The 50-period double and triple exponential moving average looking a lot better. It would be even more powerful if the red line could come and cross back above the blue line since it moves quicker. The CMB composite continues to be extreme. And the 50-period moving average, we're starting to get a bit away from that as well. The ease of movement is positive. The Arun is positive because we're above zero with our oscillator down at the bottom, and it's continuing to go up. We're starting to get extreme again with our S&P McClellan oscillator, but we're going up with the summation index based on price and volume. We're going up and not extreme with the NYSE McClellan oscillator, but the summation index for the NYSE is advancing based on price and volume. And now this had been a warning sign, but with the upthrust that we saw on Wednesday, the Swenlin trading oscillators turning back up based on price, and it already had been turning back up based on volume. So now this is not the warning sign that we were worried about. It's looking more positive now. Momentum is positive with the PMO, and then based on price and volume, we're just barely to the extreme point with the PMOs that are rising. We're going up with the buy signals, and we're starting to see more of an advance with the PMOs that are above zero. We're positive with the Elder's Impulse system for the S&P. We're positive with the parabolic SAR. We're positive and maybe extreme positive with the slope oscillator. The MACD is looking good and is positive. All of our oscillators are positive in the short, intermediate, and long term. We're getting above all the moving averages now. The longer we can stay above this, the more these slower moving averages will slow down, and the faster ones will be able to cross back above the slower moving averages. The bullish percent index continues to go up and is just a bit under 70. The NYSE bullish percent index is also positive. The NASDAQ 100 bullish percent index is positive. The money flow is positive. The ultimate oscillator is positive. The vortex is positive. The RSI 14, we're just a little bit under the 70 reading. That's when we get to an extreme positive reading. We are extreme positive with the RSI based on 9 periods. That's shorter term. We're positive with on-balance volume. We're positive with the stocks in the S&P above their 20-period moving averages. And our moving average steady. We might be able to point some kind of one of these up arrows here where this is showing a type of a breakout here. Now, other times when this happened, that led to good things after that. A couple of times that we have on this chart. Is that going to continue this time? The 50-period moving average is also positive. The 100 is positive and the 200 is positive and just barely under 80 right now. The Copic curve is positive. The Sean trend meter is starting to get a little extreme positive. And I took out the other Ichimoku cloud. We'll just focus on this. The blue line is above the red line. That's positive, and we're breaking out above the cloud. And now this green line, which is lagging behind here, it's also turning up. Standard deviation is declining slightly, but we're still above the moving average, meaning that we've been going pretty fast. The Pring bottom fisher did generate a signal in the latter part of April, and that looks to be a valid signal, at least to this point. The mass index, I'm not sure what to make of this because I was looking at the context of what generated this signal. That was suggesting to me that it could be a reversal. Well, right now, that doesn't seem to be happening. If anything, it's signaling that, okay, we were slowing down and now we're just going to kick into a faster gear. The Bollinger Bands, we're just barely on the upper end of the upper Bollinger Band here, and that doesn't happen very often. On a trending basis, we are positive with the Heiken Ashi, the Kegi, the Renko, the 3-line break, and we have another new X for the point and figure chart with a double top breakout that was generated after Wednesday's session. Sounds like a really cool dance. Long term, and maybe if we get a little further away, I can drop showing this chart for a while. We're well above this R1 level and getting a little further away from, we're almost 200 points above it now. We're still looking extreme with the 150 and 200 period moving averages. We're a positive across the board. We've been that way, and now we just continue to do so. When you look at the S&P, the mid caps, small caps, and NASDAQ 100, we're still negative in the intermediate to long term with the bonds based on price. We've switched back to positive with commodities. We're still in a downtrend in the short term with the dollar. No change yet here. I don't know if somebody actually has to come in and manually change this or if it's automatically generated somehow, but we haven't been seeing any changes with the decision point scorecard. Saw an awful lot of blue and green here. The energy sector did cross back below 70, but everything else, the S&P, the NASDAQ, and the Dow, at least what's measured here, they all set new all-time highs. And the utilities, is this the fourth day? It's at least the third day, if not the fourth day, that the utilities have set another 52-week high. Every sector was up with tech, and then real estate, seeing a little love again here, and utilities, which continue to be strong. Staples were up, but they were up the least. And that's what we want to see if we're concerned about this utilities and staples doing so well. The equal weight, both looking pretty positive. We saw a little bit of an upward move here with the mega caps outperforming the rest of the market. The Dow setting a new all-time high and looking positive. We're positive with the Elder's Impulse system for the diamonds, setting a new all-time high with the NASDAQ, setting a new all-time high with the NASDAQ 100, positive with the Elder's Impulse system for the QQQs, and we're showing the momentum is positive for the NASDAQ 100. Also looking better here. We want to see this blue line come back and cross above the red line if we're more positive on the market. Small caps, yeah, they're just still kind of at the top end. They were up 0.39%. So they were up, but they didn't really participate. However, they continue to be positive when we look at the Elder's Impulse system and the Russell 2000, starting to get extreme with the RSI. Looking good when we just look at the charts. We're in a longer term uptrend and the shorter term momentum continues to be positive. The mid caps also not back to setting an all-time high yet, but still up pretty good. The mid caps continue to be positive with the Elder's Impulse system. Apple was up and it's above its 200-day moving average, but still in a downtrend. Tesla was down 2% and coming back down to its 50-day moving average and is also in a downtrend. NVIDIA, that was one of the stronger stocks, up over 3.5% and well above its 50-day moving average. Microsoft has been able to break out above its 50-day moving average. Meta is coming back up to its 50-day moving average. Amazon was actually down and coming back down to its 50-day moving average. And Google was up over 1.25% and is still looking quite positive. The FANG index also set a new all-time high. The financial sector is still looking quite positive. It's kind of hard to tell whether that's a new all-time high or not. Might have a little ways to go. We want to see this ratio going down if we're concerned about staples and tech and looking at that ratio. When this is going down, that means that staples are underperforming. It's going down now. Will that continue? The dollar is seeing some weakness, and that's been supporting stocks. Longer term and across the world, the correlation still not really changing all that much, or the 10-period correlation is still quite strong. The staples, they were not up all that much, but they were up, and they've been in a longer-term uptrend. It's the utilities that are just, now they're not at an all-time high, but they keep setting new 52-week high day after day after day now, and they are in an uptrend. The total stock US ETF also setting a new all-time high. We were down with the 10-year based on the yield, and we're coming down to the 200-day moving average, where we were up with the 10-year based on price. And then showing some of these ratios between stocks and bonds, we're still going up when we compare tech to bonds, the QQQs to bonds, the S&P 1500 to bonds, the broad market to bonds. And this going down, that means stocks are outperforming bonds, and that continues to fall. Home construction, after it had been inside the rainbow, is now starting to come back up. Looking at 1 to 3 month T-bills, which you could call cash, and comparing it with 3 to 7 year bonds, we want to see this continue to fall to turn more positive. This going up is a concern, and it's when folks are worried about inflation and interest rates. We also want to see this ratio continue to fall. And we're going up with this ratio that the market is still embracing this idea of a soft landing, meaning that we're coming out of a difficult economic time without going into a recession. And looking at tips and then further out bonds, we want to see this continue to go down if inflation and interest rate fears are starting to subside. The Eurozone had a good day compared to American bonds. It's coming up well outside of the rainbow, but we're not seeing a lot of improvement with growth to value here. When we look at the Qs to S&P, we're actually going down with discretionary to the S&P. We turned up, but nothing really all that strong when we look at large cap growth versus large cap value. So a little bit of an improvement with the large caps, coming back up to a declining moving average with the mid caps, and coming back up to a declining moving average with the small caps. This is the 10-day average of the S&P 500 highs minus the lows, and we're up here. Now, if we keep going up, this is going to stay up here for a long time. And we're looking positive with the advanced decline ratio, both based on price and volume. The new highs minus the new lows and taking a 5-period moving average across the broad market, that's continuing to go up. The S&P to utilities ratio, this is a concern. This is going down. We want to see, is that going to be a problem? The Staples to S&P ratio is also back to going down, and that's more positive for the S&P. So what's our outlook for Thursday? Technicals are positive, but we're extreme positive. That's a fact right now. Whether that's a good thing or a bad thing, we just need to be aware of it, because we can go on for a while. If we do start to pull back, we'll be saying, okay, what's the pullback looking like? Did we hit resistance and bounce down? Because if we go up and test some kind of resistance and hit it 2 or 3 times, that's not necessarily a failure. That's actually, from what I've seen, that can tend to be positive. When we go up and just hit something and then bounce like in a ping pong ball or a pinball machine, that's when it's really being rejected. If it hangs around at that level, there's a good chance that it could come back and recapture that. We're going to get weekly jobless claims and existing claims. This seems to be a big deal to the market right now. Housing starts and building permits, which they are leading indicators. Import and export prices, the Philadelphia Fed. I think this one is important. Industrial production and capacity utilization, and just all the crazy things going on in the world. And then we'll have LEI, the leading economic index, coming out in Friday's session. And here's all the stuff that happened on Wednesday. And I just stated the things that'll be happening here. This is the previous reading. They don't have a forecast on this particular calendar. Seasonality, we're neutral to positive with the Dow and S&P. We're positive with the NASDAQ. Keep in mind that this is options expiration, and we're getting closer to Friday. And we usually end up being down that week more than we're up. Although this week could obviously be an exception, but options expiration can be its own crazy day. And then we still have another day or so for positive seasonality with the green dashed line before we might see a few days of weak seasonality. Again, doesn't mean we're going to follow this. This just trying to measure what's already happened before. Thursday is one of the more positive days of the week, and Tom Bowley still has us into this negative part of the month. So our warning signs, the mass index, now I was interpreting that as being a warning sign. Maybe it wasn't. Maybe it ended up being a positive signal. You kind of have to use your own. That's why I don't use it all that much, but I still want to pay attention to it when it's telling us something, because I like charts that just say, okay, this is positive, negative. There's no interpretation of that. Where when you have to read things into it, like Elliott wave and a lot of these different pennants and flags and lines and trend lines, even I've seen some crazy trend lines that have been drawn that break all the rules of technical analysis. But you draw enough lines on a chart, it can say pretty much whatever you want it to say. Where I like more objective indicators. We did hit a new all-time high. Staples and utilities. Now, Staples didn't do great, but utilities sure did. This is a warning sign for right now. Doesn't mean we're going to turn negative. It's just something we want to watch. Growth to value as well as discretionary to staples. Those ratios are not, I mean, they were up, but they're not breaking out. They're not showing any real strength right now. We're still going down with our 5-period equity put call ratio, and then all the positive things here. Just go, it's been on this list for quite a while now. We've got quite a lengthy list of positive indicators. So our conclusion, we're positive, but we're extreme positive. We can say that in the short and intermediate term, and we can even say that to a degree in the long term, but we're still positive for right now. We'll just be waiting to see. Is weakness going to start to develop? Is the idea that volume has been below average, is that going to be a big deal? Utilities still screaming up. Is that going to come into play at some point? For right now, we're looking positive, but we want to be aware of those other things. Thank you. I really hope you have a great day, and I will talk to you in the next video.